How the 2008 financial crisis still affects you. Even though it has been more than a decade since the financial crisis that occurred in 2008 to 2009, there are still lessons that can be learned from this economic depression. The global economy entered the Great Recession, which was the most major economic downturn since the Great Depression, as a direct result of the crisis itself. The aftermath of the crisis resulted in the establishment of new regulatory bodies and regulations, such as the Troubled Assets Relief Program (TARP), the Financial Stability Oversight Council (FSOC), and the Consumer Financial Protection Bureau (CFPB). In the aftermath of the crisis, alterations were made, laws were enacted, and assurances were given. Financial institutions were rescued, stock markets broke records, and the United States government offered lifelines at institutions that were supported by the federal government. Because of the circumstances, policymakers were compelled to make crucial judgments with conviction and haste, which contributed to the formulation of laws and improvements for the future. 1. Being too big to fail. There was the idea that global banks were too big to fail that served as the pretext for lawmakers and governors of the Federal Reserve to rescue them from their financial predicament. To forestall a systemic crisis, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted. The act established organizations such as the Financial Stability Oversight Council (FSOC) and the Consumer Financial Protection Board (CFPB) to act as watchdogs on Wall Street financial institutions. Dodd-Frank mandates that financial institutions with assets worth more than $50 billion must submit to stress tests and eliminate speculative bets, which have the potential to destroy balance sheets and cause harm to clients. Several financial institutions, particularly credit unions and regional banks, voiced their opposition to the act, arguing that it hampered their ability to provide service to their consumers by burdening them with documentation that was not necessary. In May 2018, President Trump gave his approval to a revised version that featured fewer restrictions and bureaucratic impediments. 2. Reducing risk on Wall Street. During the crisis, financial institutions engaged in proprietary trading, which resulted in losses for both the institutions themselves and their customers. As the number of lawsuits increased, trust began to erode. The Volcker Rule, which was enacted in 2014 and was named after the former chair of the Federal Reserve, was designed to prevent financial institutions from engaging in excessive risk, taking about their trading in speculative markets, which would result in a conflict of interest with their customers regarding other goods. Jerome Powell, the chair of the Federal Reserve, cast a vote in May 2018 to weaken the act, citing its complexity and inefficiency as the reasons. Following the financial crisis that occurred in 2008 to 2009, financial institutions increased their capital requirements, decreased their leverage, and decreased their exposure to subprime mortgages because of these changes. Neil Kashkari, the president of the Minneapolis Federal Reserve Bank and a former overseer of the Troubled Asset Relief Program (TARP), thinks that large global banks require oversight as well as strong capital requirements. He stated the following to Investopedia: "Throughout history, there have been instances of financial crisis. However, it is inevitable that we forget the lessons and continue to make the same mistakes. The pendulum is currently swinging against additional regulation. Nonetheless, the fact of the matter is that we need to be more stringent with the largest banks that continue to pose hazards to our economy's stability." 3. A housing market that is overheated. Unscrupulous lending to borrowers who did not meet the requirements for the loan, as well as the resale of loans through financial instruments known as mortgage-backed securities, contributed to the overheated housing market that existed before the onset of the financial crisis. As a result of the banks purchasing insurance against those mortgages, a house of cards was constructed on the foundation of purchasers who were unable to afford the mortgage of the time. Both Fannie Mae and Freddie Mac, two government-sponsored organizations that underwrote a significant portion of the mortgage risk and resold it to investors, were bailed out with money from taxpayers and placed under receivership by the federal government. Home values dropped, the number of foreclosures increased, and many people lost their homes. Under the supervision of the Federal Housing and Finance Agency (FHFA) in 2023, Fannie Mae and Freddie Mac are functioning as financial institutions. There is blame everywhere. In 2009, many people and organizations were responsible for the incident, yet it was difficult to demonstrate wrongdoing. A significant number of the most illustrious establishments on Wall Street and Main Street prioritized their interests above those of their clients. In the aftermath of the crisis, Phil Angelides was appointed chair of the Financial Inquiry Commission. The purpose of his investigation was to determine the reasons for the collapse of the global economy. He stated to Investopedia, "In most cases, we gain knowledge from the results of our errors. However, Wall Street never undertook the critical self-analysis of its activities or the fundamental changes in culture that were demanded by the crisis that it caused. This is because Wall Street was spared any significant legal, economic, or political penalties as a result of its reckless behavior." 5. Putting money into the future. As of September 2023, the percentage increase in the S&P 500 since 2009 was over 394%. Following the financial crisis that occurred in 2008, the global stock markets experienced an increase in market value as a result of reduced interest rates, bond purchases by the central bank, quantitative easing QE, and the rise of FAANG stocks. An entirely new group of investors has entered the market as a result of the introduction of automated investment tools and robo-advisors. Compared to the amount of $0.8 trillion in 2008, the assets that are allocated to exchange-traded funds ETFs have increased to over $7.6 trillion in 2023. Unlike mutual funds, exchange-traded funds ETFs can provide investors with liquidity as they trade like stocks. In 2008 and 2009, exchange-traded funds were still in their infancy. The lessons learned from the financial crisis that occurred in 2008, which started with the collapse of the subprime mortgage market in the United States, were brought back to the forefront during the COVID-19 pandemic that occurred in 2020. Once more, central banks intervened to achieve their goals of lowering interest rates, increasing the money supply, and providing assistance to businesses. The Consumer Protection Act of 2010 is a piece of legislation. The Consumer Financial Protection Bureau (CFPB) was established according to the Consumer Protection Act of 2010, which is commonly referred to as the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. The purpose of the CFPB is to centralize the regulation of a variety of financial goods and services. To stabilize the financial system, what actions did the Troubled Asset Relief Program (TARP) take? Following the financial crisis that occurred in 2008, the United States Treasury Department established the Troubled Asset Relief Program, also known as TARP. Through a government purchase of mortgage-backed assets and bank stocks, the Troubled Asset Relief Program (TARP) helped stabilize the financial system. From 2008 to 2010, the Troubled Asset Relief Program (TARP) invested a total of $426.4 billion in various companies. What is the failure rate of banks? The FDIC reports that between 2001 and 2023, there were 565 failing banks. What is the bottom line? Painful lessons were learned from the financial crisis that occurred in 2008 to 2009. To put an end to the crisis, the government and the Federal Reserve took immediate, unprecedented, and drastic actions. Additionally, reforms were put into place to decrease the likelihood of another catastrophe occurring. During the economic fallout that occurred as a result of the worldwide COVID-19 epidemic in the years 2020 to 2021, politicians from around the world reassessed lessons learned to immediately help the financial economy. Trade when you are on the move, no matter where or when. The readiness of one of the leading cryptocurrency asset exchanges in the world is ready for you. Trade in a secure environment while taking advantage of competitive costs and devoted customer assistance. You will also gain access to Binance tools that make it simpler than ever before to check your trade history, control auto investments, view price charts, and perform conversions without incurring any fees. Register for a free account and become one of the millions of traders and investors in the cryptocurrency market across the world. Would you like it? Don't forget to like and subscribe our YouTube channel for more interesting and informative videos.